Hello and welcome to Bazaar Morning Call, live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Morning.
I trust everyone has had a restful weekend, although Nigel was complaining it was too short.
Too short.
Weekends are always too short, right? You can do with... You know, there's so many countries in the world that have 3-day weekends now.
I mean, start of a week, Sonia. But it's a heavy week, right?
Yeah,
because earnings season kicks off. So, I mean, we've got our hands full. But, you know, we got our hands full not just in terms of what lies ahead of us, but also with what happened on Friday. And I just want to start with that because I think the tone, the direction, everything will be set with what happened on Friday. It was pretty large. So just look at the three things. You got the S&P 500, you got the Dow Jones, you got the dollar index, right? So very large moves on Wall Street in terms of the US price action. Equities rallied 2.5%, as you can see. The Nasdaq was up 2.5%. The dollar fell a full 1%. It fell below the 104 mark. And you got yields which came off very, very sharply as well. This is the sort of the rates market, the yield curve. The very short term, the 2-year, which fell 20 basis points. That is massive. The 5-year fell 21 basis points and the 10-year fell 12 basis points. This is just Friday. I mean, actually, bulk of the move last week came on Friday. So if you just look at the full week moves, it'll be this much or maybe a little lesser because the majority of the moves was on Friday. But in any case, these are huge, very, very large moves. What was the reason? Greater signs of US and global disinflation. And, you know, right now we'll just focus on the US aspect of it because that's the latest data. We were all focused on the jobs number, right? I mean, I think we talked about it on Friday as well, Thursday, all week last week. But the real shock came from the ISM services number. This is a survey, mind you, and that number came in at 49.6 as compared to estimates of 55. And the prior number is 56.5. So we are in contractionary zone as far as the ISM services is concerned. Why is this important? Two things. One, the services part of the US economy is huge, it's very, very large. And services inflation is sort of seen to be much more stickier, much more difficult to get rid of. And number two, the ISM services number is kind of fallen in line with other high-frequency numbers. ISM manufacturing was looking weak, PMI numbers were looking weak, but the services was not. And with this data point, the services number has fallen in line with some of the others. So it's more consistent now. So that's that. The jobs number was important, but it was neither too hot, neither too cold. But I think the reason why markets liked it is because the one component, average hourly earnings, saw deceleration, both on a month-on-month basis and a year-on-year basis as well. So, you know, two data points, big data points. The bigger, I think, the more impactful was the ISM number, both showing that inflation perhaps is coming under control in the US. It's going at least in the right direction that the Fed wants it to. I mentioned what sort of, you know, yields and stocks, etc. did, but market pricing of what the FOMC itself will do fell 5 basis points on Friday to 33 basis points, which means markets expect that in the February meeting, the next FOMC meeting, the Fed meeting, they will take rates up by 33 basis points. So that is interesting. This week we get CPI, that is on Thursday, 12th of January, and hopefully, just hopefully, fingers crossed, I mean, the data comes in soft, and it could tip the balance decisively towards 25. We're at 33 market pricing for Feb. Hopefully it goes down to 25 as compared to 50, which was where we were before the Friday data point actually came through. So that's the global aspect, and I think this is important because this is right at the beginning of the year, a tough first week for US markets, for our markets as well, and you get this data which kind of tells you that maybe 23 we are starting in terms of disinflation, you know, inflation peaking at least. Perhaps, I mean, the Fed will sort of see this favorably as well. Just a few points on the market here. The Nifty made a double, I mean, I think it has made a double bottom on Friday. We were talking about the December 26th low, which was 17,774. So we didn't quite get to it, almost exactly to it, but within 20 points of it, and then the market bounced. We've done that twice, actually, apart from the 26th low itself. After that, we've done this twice. So perhaps, just again, fingers crossed, perhaps we made a bit of a double bottom. Today's price action is important. If the markets hold and close higher, it's going to be a gap up. The SGX is showing that very clearly. I would say it could perhaps be a signal, the start of a bit of a tactical up move. The budget is around the corner, you know. Could this kind of trigger a bit of a budget move, a budget rally, pre-rally, etc.? We'll see. But, I mean, signs are looking much better as compared to where we were last week. On the upside, I mean, the low, of course, which has to hold is the 17,774 low, which is a December low at the double bottom. 18,200 is the first level to watch on the upside. Two reasons for that. This number, 18,200, is the 38% retracement of the fall from the all-time high to the December 26th low. The first retracement is 38%, then we get to 50 and 61.8, but that comes later. But 18,200 is that first number. The 20-day moving average also kind of coincides there, which is 18,214. So, I mean, 18,200, 18,214, 215, that cluster, I think, becomes the level to take out, the first level to take out as we begin today's session. We can get into sectoral implications. Rates have fallen. It's positive for technology. Dollar is weaker. It's positive for metals, and we can get into that discussion later. But I think it's a more constructive kind of view as we begin today's session. But there is, of course, I mean, a lot to track as we kick it off from here. Guys.
Okay, that was quite exhaustive. I mean, all the cues put together, right, for the day. So just wanted to put a couple of more points on board. The SGX Nifty, of course, indicating that there's going to be a big start. So the big question on everyone's mind is the worst over in terms of the sell-off globally? Now that inflation is cooling off, maybe rates may not be hiked further. In that aggression. So is the worst over from a global standpoint? It's important to see if the Nifty reclaims and holds above that 100 DMA. Remember, 17,900, which was the 100 DMA, was broken on Friday. Now, if we do see a pullback, a short covering rally, will the Nifty hold above this level? That is the important thing to watch through the course of the day. Very good global cues, strong handover, 700-point rally on the Dow. Even the Dow futures, in fact, I checked last, was up almost about 30-40 points. The problem is FIs continue to sell in very large quantities. So yesterday as well, I think for the 11th straight day, FIs have been selling, and now over 2,900 crores of selling coming through. The good part for our own markets is that a lot of the local cues have been strong. So the updates that have come in, whether it's from Titan, from Kalyan Jewellers, from Tata Steel, Tata Long Products, all of them indicating about a single-digit, high single-digit to double-digit growth in their business updates. So that's looking pretty good. Decent growth from Bandhan Bank as well. Advances were up 14%, deposits up 21%. But the big cue to watch will be TCS's earnings later in the evening, and we officially kickstart earnings season. I think the street knows that the IT sector is expected to post a soft quarter. You know, HCL Tech highlighted it mid-quarter about higher furloughs, etc. So the earnings expectations are very low, but that's the list. There's HCL Tech, Infosys, then Wipro, followed by HDFC Bank on 14th as well. So we'll be watching that very closely. But the big question on my mind, after today's gap up opening, will it sustain or will it get sold into? Because the texture of the market has been on the weaker side, Nigel.
Well, guys, those who have taken long positions on Friday, they'll be happy to see this gap up opening. Otherwise, it's getting even more tricky today. Because if you're going to get 100, 130, 150 point gap up, then it makes it even more tricky for the bulls, because sustenance is something that we're looking forward to. Last couple of sessions, buying the intraday dip, that's what's worked for you, right? If you bought it around 17,900 or 17,800 in the last two sessions, you'll be happy because you made some money provided you caught the low. The problem is, even if we have a bit of a rally, the 18,250 to around 18,350, that's a congestion zone. We have gone there a couple of times. 18,250 the last week, thrice is when we went there. But that level got rejected. Institutional flows, that's a worry. That's why I'm saying this gap up could be music to the ears of some of these institutions that want to sell, or the FIs in particular. Because the FIs last 11 sessions, they've sold close to around 14,000 crores odd. The last 3 sessions, the FI and the DI data, I look at it together. And last 3 sessions, 1,800 crores is the net sell number that we're getting. And just one more point on the FI, well, we got a large sell number coming in from them, but the gross participation on Friday was much lower. So let's hope today, we get a better idea, the participation is higher, and then you get a sense of what the FIs exactly want to do with the markets. Moving to the options data then, the call writing continues and was very, very aggressive. The 18,000 call, the 17,900 call also, the bears clearly believe they are going to be protecting these higher levels. However, what gives you hope is on the downside. The 18,000 put, on the put side, that has the highest open interest. You deduct 175 rupees from around that 18,000 odd mark, and it gives you that support level of around 17,800, 17,825 odd, which brings us to the technical levels. On the upside, we're looking to get to around the 20 and the 50 DMA. However, today you like to close comfortably above the 100 DMA, given the kind of opening that we are seeing. So a closer to around 18,000, that'll be good news for the bulls. Support on the Nifty, 17,750, the recent low is out there. We bounced from there on Friday as well, that's 17,800 odd. So you're counting on that level, holding out. And the Nifty Bank has to play a role today. If we have to see a bounce, Last two sessions, it's been underperforming. Can it give up its underperformance and move closer to around the 50 DMA, which should come up for you on the screen? It's at around 42,665. You want it to move towards those levels because it bounced off Friday's lows. SGX Nifty suggests a gap up start. Tricky start though. Maybe buying the intraday dip and not chasing this opening will be more prudent.
Okay, another thing, right, to watch out for is crude.
Yeah.
Crude is now below $80 a barrel once again. As we told you earlier as well, it's seen a big fall in the last many days. So that's another big positive for our own markets. So a lot of triggers in favor of the bulls, but important to see if that 100 DMA is held or not.
Oh yeah, absolutely. And you know, some of these levels do come in a very useful way. So keep track of those. Well, let me just quickly start by telling you what is lined up here in the program. So Power Packed as always. First half hour of the show, we'll get you updates from markets across the globe. Matt Orton of Raymond James Investment will join us to discuss this setup. Research team brings you the top 10 stocks to watch out for the day, both negative and on the positive side. We'll get you a fundamental stock analysis with Siddhartha Khemka of Motilal Oswal Financial Services. That's from 8 to 8:30.
Okay, so we have lots coming up in the next 2.5 hours. Without wasting any time, let's get straight to it. First up, we have an equity view coming in from Vikas Jain of CLSA, who expects Q3 FY23 pre-exceptional profits before tax for their India coverage to grow 10.5% year-on-year, driven by a strong growth in banks, PSU, oil and autos. He says domestic companies are expected to report a sequential improvement in margins after 6 consecutive quarters of a decline. He also adds commentary on rural demand, post-festive demand, and margins will set the tone for FY24 analyst estimates. He says due to their less bullish outlook on earnings of some autos, metals and energy companies, their Nifty EPS estimates are 7 to 8% below consensus.
Okay, this is a money market view coming in from B. Prasanna of ICICI Bank, who says that moderation of wage growth numbers and weak ISM services print have triggered expectations of a fall in services inflation. In effect, US benchmark yield fell sharply alongside the US dollar. Chinese yuan is supported by reopening of the economy, and that led the Asian pack stronger, but the Indian rupee still remains an underperformer due to RBI buying and lack of significant inflows. For this week, Prasanna expects the rupee to be in a range of between 81.9 to 82.7 in an environment of dollar weakness, with the RBI smoothing out the volatility from sharp adjustments.
Okay, and on the bonds, right, B. Prasanna says US yields rallied sharply on softer economic data as early pivot from Fed gets priced in. China growth concerns resulted in lower crude prices favouring domestic inflation outlook. However, bonds in India remained under pressure owing to the upcoming fiscal budget and expectations of large borrowing numbers. Inflation data due this week is expected to ease both in the US and in India. He expects bonds to trade with a positive bias and the 10-year benchmark to trade in a range of 7.2 to 7.4%.
Well, we have a lot of stock-specific action to track for you today, and we'll get to that in just a bit in our special Top 10 segment. Well, stocks we're looking at include Asian Paints, Tata Steel, Titan, Kalyan Jewellers, ACL Tech, IDBI Bank, Paytm, and Phoenix Mills. All of them on the back of positive news flow. However, a couple of them could react to negative news flow. That's Bandhan Bank as well as Biocon.
Matt Orton is now joining us. He's Chief Market Strategist at Raymond James.